So public sector mortgages. So what are they? How does it work? What's the difference between a public sector mortgage and a normal traditional mortgage? And the answer to the last question is very little. You're still borrowing money, you still have to pay it back. Same thing, the interest rates on a public sector mortgage is the same as any other mortgage. But the big difference would be in the amount of lending that public sector employees can get. And how that works is that we can increase your earnings based on your salary scale. And we can move up 2 points in your salary scale and we can lend on the higher number, which essentially means that you get more money and you can borrow more money than non-public sector employees. But in essence, the mortgage itself is exactly the same. The interest rates that the banks charge is the same as a non-public sector. There is no difference other than that. I mean, the lending figures are the big one. Variable incomes can also be given to public sector. So if you are on sort of variable incomes over and above your basic, then we can take those into account, 100% of those as well for lending. So it really comes down to the amount of money that you can actually borrow. And for public sector, you can borrow more than non-public sector. But essentially, that's the biggest difference. Have a look at our blog this week, guys. If you have any questions on mortgages for the public sector, we're more than happy to have a chat with you and answer any questions you have. Bye for now.